So I had somebody comment on one of my posts that I talked about. So if you don't know the Roth, like if you have a Roth IRA, for example, there is a max contribution. Here's what I'm gonna do. I'm gonna actually bring it up on my Zoom. Let me see. That way everybody can see it. Okay. So there is a maximum contribution limit to a Roth IRA. Let me see.
Recording in progress.
Okay, cool. Make sure. Okay, share my screen real quick. So the Roth IRA, the comment was, hey, there you can get around. Like, let me see. The comment was, hey, you said there's a maximum contribution. That's not the case. Well, it is the case, but I understand where the comment was coming from. So let me see real quick. So Roth IRA limit. Let me see. Okay, so Roth IRA limit 2024. Let's see 2025 numbers. I don't know. Okay. We can just go to IRS. IRS.gov is cool. So, okay. Limit 401k limit increases to 23,500 for 2025. IRA limit remains 7,000. Highlights for change. I just want to see something that's easy to read. Single taxpayers covered for work retirement, a phase out between. Let's just go back here real quick. What did it say? Okay, so max contribution to a Roth IRA in 2025 is 7,000 if you're under 50, and it's 8,000 if you're over 50. Okay, and then single filer. So if you make too much money, you actually do not qualify for a Roth IRA. So the conversation that I was having, and I'll bring this up real quick. The conversation I was having is there's this term out there called a Henry. Let's see. There we go. So there's a term I hear called a Henry that most people are unfamiliar with. It's a funny term. It says high earners that are not rich yet. Let me see. Right? High earners that are not rich yet. Okay, individuals who currently have significant discretionary income and a strong chance of being wealthy in the future. So this is somebody who's making good money, right? High earners, not rich yet. Individuals who currently have significant. Okay, the term Henry was coined in a 2003 Fortune magazine article by Sean Telly to refer to a segment of families earning between $250,000 and $500,000, right? So high earner, but not necessarily rich yet, right? The reason why I brought this term up was because when you have a Roth IRA, if you make this number here, right, 250 or half a mil, you're not necessarily like rich, right? Like you're not like wealthy yet, but you are a high earner. You're making multiple six figures, right? And so the limit for someone who files as a single filer, is 150. So 150 married or jointly filing to what $236,000 would be the max that you can the max income that you can make in order to contribute to your Roth IRA, right? And so obviously, for those that are unfamiliar with Roth IRAs, Roth IRA allows you to grow money tax free. A traditional IRA, it's a you get taxed, your income gets taxed first, and then you can, you're gonna grow the money. So you get taxed now versus I'm sorry, traditional IRA, you will get taxed later. I'm sorry. So you put your money in, it's gonna grow, and then you will be taxed on the back end, similar to your 401k, right? The 401k, what's the benefit of a 401k? If I make $100,000 this year and I, put away 20,000 into my 401k, I'm gonna get taxed on 80, right? I'm gonna get taxed on $80,000. My money's gonna go into the 401k, and then when I retire, I get taxed on the back end, right? So watch this. How much do I get taxed on my 401k when I retire? Let me see. Okay, 20%. So 20%, there is a withdrawal percentage, typically around 25%. You'll be taxed an additional 10% when you file, right? If you take out money early, you're getting hit with a 10% federal tax, 3% state, right? And so let me go to this. I just want you guys to see, like, this is this stuff's simple, just looking it up. Like, so there's this concept of like a bag of seeds when trying to understand this stuff. That bag of seeds, taxes. Let's see if this comes up. Taxes, cool. Blah, 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 blah. Okay, well, the example is this, right? So the example is, would you, if somebody said they're going to take half of your seeds, right? Would you rather you have a bag of seeds. Would you rather they take half of your seeds now and then you can go plant your forest of trees, right? So I have a bag of seeds, you take half of my seeds and then give me the freedom to go plant my trees, right? That's the example of a Roth IRA, right? You get paid, you get taxed on the money that you get paid, put that money into a Roth, it's going to grow tax advantage, basically tax free, right? The idea of a traditional IRA or, for example, a 401k is going to be, hey, I'm going to get my bag of seeds. I'm going to plant my tree, plant my forest. It's going to grow into a big forest. It's going to be a bunch of trees, right? And then once I have all of these trees, now you come in and you're going to chop down, basically, you chop down half of my trees, right? And that would be the tax in the future, right? And so that's kind of the basic visual idea. If you're confused, like what's the difference between a Roth IRA versus an IRA? A Roth IRA, take my seeds now and give me the freedom to grow, or a traditional IRA, hey, I'm gonna grow my seeds, leave my seeds alone, I grow my seeds, and then you tax them on the back end. Right. And so with that, the reason why this whole conversation came up was this idea that, hey, okay, with a Roth IRA, you do have a maximum contribution. And then the conversation said, yeah, but there's other ways around it, right? And so basically what the idea behind this is, if you've ever heard of something called a backdoor, it's this thing called a backdoor Roth IRA. It's not a new type of Roth IRA, it's just a way to fund it to where you can actually kind of get around the contribution numbers. And so the way it works is yeah, you would contribute to a traditional IRA. You see here. Uh-oh. See, I pulled this. I don't know why it keeps doing that. But okay, cool. What you would do is you would contribute to a traditional IRA, but you have to make sure there's certain tax forms that you would fill out. You would have to make sure that you contribute as a non-deductible, right? So it'd be a non-deductible contribution. I don't know why this thing's not popping up. Let's see if I can pull this up. Mm, I don't, and I don't even know whose chart this is, but just where is this at? Okay, yeah, yeah. So you would contribute to a traditional IRA. It would have to be a non-deductible contribution first, the max 7,000, right? And then you can convert that traditional IRA to a Roth IRA. When you convert, they'll ask you, "Are you sure that you did this the way that are you sure you just don't want to change it to a Roth?" No, no, no. It has to be a conversion, and then there's a couple different forms you can fill out. So the idea behind this, though, is that you can make more than, or you can contribute more than the cap $7,000, because you can also convert your traditional IRA as well, right? And so that is a way around. I mean, a lot of people aren't familiar with it, but it's what they call a backdoor IRA. And the reason why the comment was brought up was because I didn't offer that as a solution. The solution that I offer, I do work with, which is like IULs and stuff. So if you ever heard of this idea of the rich man's Roth, right? The rich man's Roth. Let me see. Da-da-da-da. Okay, so the rich man's Roth is a nickname for a cash value life insurance policy that offers tax-free growth and withdrawals, right? It's an alternative for a Roth IRA, people who earn too much money to qualify for one, and so forth, right? The difference here is that, so this is a permanent insurance policy. Insurance policies are not Roth IRAs, right? It's just not, because you are buying insurance. So there is a purchase of insurance required for something like this, the rich man's Roth for the most tax-free retirement income. Yeah. So what's going to happen is it's a permanent insurance policy, but the insurance policy allows you to grow money in there tax-free as well. The difference is there is no ceiling on how much you can grow in a IUL, or like a whole cash value whole life policy. The reason being, if you want to grow more money in the policy, you just get more insurance, right? So you put here what one tax minimizing strategy is a Roth IRA. Yep. However, the rich person Roth could be a key to unlocking more tax-free income in retirement, built on the back of a cash value life insurance policy. Easiest way for high earners to unlock financial freedom. Okay. So here's the thing: there's always a plus and minus. A Roth IRA, there's no money tied to insurance, and you can grow that money tax-free. It is tied to the market, but there's no insurance to it, right? It does have a cap. The difference with a IUL, for example, there's insurance. I gotta pay for life insurance for this, right? But by paying for life insurance, there's a tax code that you get access to through life insurance that you don't through other means and so forth. It also gives you the ability to put in as much as you want. Think 401k, IRA, financial house, yeah. Okay, so the last thing, what's this? Rich person Roth is not some tool only available to the rich. Yeah, it's not just for super rich people. Like you can put in money. The difference is if you're only putting in $100 a month, you're not going to see a whole bunch of growth in an IUL. Let's just be honest, right? Insurance policy, you're putting $50 a month into an insurance policy, and you're expecting to have $1 million when you retire. No, you'll probably have nothing because the $50 was just paying for the insurance, right? And so the challenge is a lot of people in insurance, they're trying to like peddle insurance as like, oh, it's the best investment. No, if you for everybody, no, if you only have $50 a month, put that in a first off, make sure you have some savings, right? But then put that into maybe a ETF or a Robinhood account or something. And once you have some real discretionary income, you can start looking at options like this, especially for those guys that those guys and gals, sorry, that are making decent money in like the tech space or lawyers, doctors, things of that nature, right? And so I think the last thing here, oh, the tax code. So the tax code 7702 that I was talking about, this is a tax code you have access to when leveraging insurance. Some people try to call this thing like a 7702 plan. BS. I'm sorry. They're just trying to get you to want to look at it without just saying it's a life insurance policy. It's not no 7702 plan. It's a life insurance policy that takes advantage of tax code 7702, right? And so IRS section 7702 da da da. IRS tax code defines the federal government considers a legitimate life insurance contract, determine how much proceeds the policy generates or tax. Okay, so the proceeds of a policy do not meet the government's definition of a taxable ordinary income. Proceeds from a general life insurance policy are tax advantage, right? And so that's why, like, if you're familiar with annuities or even insurance, it's the tax. It's there's beneficiaries, right? And then there's so that helps bypass probate for legacy stuff, legacy talk, and then requirements of 7702. So there's something called a cash accumulation test, and there's also something called a MEC. There you go, modified endowment contract. Each policy, the bigger the policy, the more money that you can put in. So if you only have $100,000 of life insurance, there's a certain number, depending on your age, that you can put in for the cash. Bigger policy, $1 million policy, more cash I can put in. If I try to put in the same amount of cash for $1 million policy into $100,000 policy, I get hit with it's a MEC modified endowment contract, which means you've put too much money in, so you've kind of broken the threshold, and you will now get taxed on the contract. And so there's a number, like if you look at an illustration with an agent out there, like there's a number where you'll see like, hey, don't go above this number or this will be taxed, right? And so all this stuff is pretty simple. It's just a matter of just being educated on it, having somebody break it down. The person unfortunately, just people have to be able to just be like, just offer this stuff just for information. Like I work in life insurance. I get paid when people buy life insurance products. If a life insurance product's not for you, it is my job to tell you that as well, right? Unfortunately, there's a lot of people out here that are thirsty. They're just trying to get commissions and stuff. Like, no, it's a matter of like what's best. Because what I've learned is that the only reason that people make money in business long term is because they're solving problems for people. So somebody makes a car and that car can get you from point A to point B, they get paid, right? And so if insurance policy, for example, is a good option for you in your current situation, then great. If it's a bad option, then guess who it's bad for? It's bad for you to buy it. It's like, let's think about just energy. It's bad energy for you to buy it. It's bad energy for me to sell it to you, right? It's bad for everybody. Eventually you cancel the policy, you don't have as much, you don't have the money to keep it up, right? So it's all a matter of like just education, truly understanding this stuff first, and then everybody can choose what makes sense. Excuse me, based on their current situation, right? That's why, like in the annuity side of insurance, there's something called suitability, where like you really can't even get an annuity if it's not a suitable product for you, right? Like because the whole idea of annuity, it does your money is kind of locked up for a bit, but you have access to 10%, whatever. But if it's all your money, the insurance company won't even allow you to get an annuity because there's no point to get it if you're going to be pulling all of it out, right? Like the next month or something, right? And so anyways, hopefully this answers some questions. Like I said, I didn't mean to not mention like the backdoor Roth IRA method. It's not a product. It's a way of moving money around. And so, it takes a little bit. I would suggest for that, what's it called? For that scenario, like to have a tax advisor, talk to somebody in taxes. I'm not a tax advisor. So, just don't take this as like law, right? It's like, this is introduction. We're doing research literally on Google, right? But like, do your own research, read There's different books out there that talk about like, tax-free retirements, all that different stuff. Like, read a book. Read a book. This stuff's simple. This stuff's out there. We just have to go take the time and initiative to learn it, right? So